When it comes to investing, a lot of people naturally start closer to home. UK stocks, familiar brands, companies you know. But there can be a risk to sticking too close to home. In this video, we're talking about investing globally, why it matters, how it works, and how it could help you build a more resilient portfolio, wherever you're based. One word: diversification. When you invest globally, you're spreading your money across different economies, sectors, and currencies, which could help reduce the risk of being too exposed to any one country's political decisions, tax changes, or economic cycles. It's easy to fall into what's called home bias, investing mainly in your own market. But if that market underperforms, your whole portfolio could suffer. A well-diversified global strategy could help reduce investment risk. Global diversification means investing across a mix of countries, from developed markets like the US, Japan, and Europe, to emerging markets like India, Brazil, or China. That way, even if one region is going through a rough patch, another might be doing well, helping smooth out your overall returns. You also get currency diversification. As a UK investor, that means you're not relying solely on how the pound performs against the US dollar, but also giving exposure to currencies from the euro to the yen, or even the Mexican peso. There's also an interesting bonus. Investing globally gives you access to markets that may be better value. One way to measure this is the price to earnings, or PE ratio, which compares a company's share price to the profits that it makes. A higher PE ratio means investors are paying more for each pound of profit, while a lower PE may signal better value. Right now, with markets hitting new highs, the US looks more expensive than many other regions. Even strong markets go through tough times. A great example? The US between 2000 and 2010. Despite being the world's largest economy, US equities were effectively flat for a decade. If your portfolio has been fully invested in the US during that time, your returns would have stalled. That's why global exposure matters. No single market leads all the time. Now, not all global indices are created equally. It depends on how the index is constructed, and it's worth knowing the difference. The FTSE All-World Index offers one of the broadest market exposures. It includes large and mid-sized companies from both developed and emerging markets, representing around about 98% of the global investable market. It covers over 50 countries and more than 4,000 companies. The MSCI World Index is also broadly diversified, but only includes developed markets, about 23 countries and roughly 85% of the value of all stocks in those markets. It excludes emerging and frontier markets altogether, for example China and India, as well as smaller markets such as Bulgaria, Peru, or Vietnam, to name a few. Both offer broad exposure, but the FTSE All-World Index goes further in terms of reach and diversification. Here's something else to keep in mind. Even global indices can be heavily weighted towards the US. The US currently makes up 63% of the FTSE All-World Index and a massive 73% of the MSCI World Index. That's just a reflection of how dominant US companies are, especially the largest companies in technology and consumer products, and how quickly the US market has grown. In 2010, the US was less than 50% of the MSCI World Index. But if you're concerned about concentration risk, one way to reduce it is through an equal weight approach. Instead of giving more weight to the biggest companies, an equal weight index treats every company the same, giving each one an equal share of influence on performance, regardless of size. In the MSCI World Equal Weighted Index, for example, US exposure drops from over 70% to around 42%. It's a pretty big shift, and it can lead to a very different return profile. You don't need to build a global portfolio manually, buying individual stocks or juggling dozens of funds. That's where global equity ETFs come in. They can give you access to thousands of companies across dozens of countries in a single investment. ETFs can be an efficient, cost-effective and easy-to-manage option, which is why so many investors, including us here at Invesco, see ETFs as a powerful way to invest globally. Before you invest, there are a few things to look out for. Which index does the ETF track? Not all global indices mean the same thing. Are you happy about the level of emerging market exposure? Is the fund market cap weighted, where a company's weight within the index is proportional to its total market value, or equally weighted, where regardless of market value, each company has the same weight within the index? And finally, What's their currency exposure? And if it's important to you, is a hedged option available, which aims to reduce the exposure to fluctuations between currency exchange rates? These are all things that can affect your investment experience, and they're worth understanding. To wrap up, investing globally could help reduce risk, expand exposure to a wide range of countries and sectors, and build a more resilient portfolio over time. It's easy to default to what you know, but the world's a big place, and global ETFs could help you make the most of it. To get started, explore Invesco ETFs on InvestEngine and take your portfolio beyond borders.